Hello and welcome to Investors Hangout, your weekly guide to making smarter financial decisions. This series is brought to you by Aditya Birla Sun Life Mutual Fund and Value Research. Now, today we're tackling a question that challenges the conventional wisdom. Is it ever okay to retire with a 100% equity portfolio? And to help us make sense of that, we're joined by our in-house expert, Dhirendra Kumar. Welcome, Dhirendra.
Thank you.
First up, what does 100% equity really mean?
100% equity really means that no debt, no fixed income. All your financial holdings are equity or equity fund or index fund. That is 100% equity. If you hold anything which is a mix of equity and debt, which protects the downside, or the fixed income, many times, people mentally earmark that their provident fund, they don't count as their investments or, something like that. Or public provident fund or something which is your fixed income allocation for the very, very long run. They don't mentally compute it. They think that, okay, this is sacrosanct. And, that itself is, I think one should be looking at financial investments holistically.
Right. But we often hear and we often say that everyone must hold some debt, more so in retirement. Why is that so?
Simply because equity markets go to the extremes. And if you don't have that fixed income, how will you capitalize on it? And how do you capitalize on those opportunities? Because equity will keep creating opportunity. That is the design of the thing. That is the mechanism of that is how it works. Equities will be volatile. Sometimes it will scare you, and that is the time when it will be worth investing. And if you don't have fixed income, so as an opportunistic preparedness to capitalize on those opportunities, everybody should have fixed income. Now, how much fixed income? That is also a function of scale.
So that's where a viewer's question comes in. You even wrote a first page column on that. 66-year-old with pension, with rental income and no dependents at all. So his question was, why should he hold debt at all? What's your opinion on that?
To my surprise, he is not alone. On Saturday, I sent this editor's note. And in this editor's note, I came across at least about 100 of our users who said that I'm in a similar boat. And most of the people who said that they are in the similar boat, they were also of the opinion that they always have some fixed income, just in case, God forbid. That is one reason. You have all the flows, you have all the preparedness, but I think, it is a function of scale. I don't think it is a matter of percentage of your net assets or net worth. I think it should be looked upon more practically, that what could be the worst case scenario? Because our thinking is also malleable. We change our thinking depending on the state of the market. If market goes down by 40% and remains there, keeps drifting at those levels for another 2 years, will you be thinking the way you are? That is also dependent on scale. If your net worth or financial worth worth of the financial assets is substantially 5 times more than 4% withdrawal rate that we are talking about, it will be okay. You will not panic. But in other cases, you might panic. So I would say that general prudence of some fixed income allocation is needed for everyone. It could be 10% for a long-term investor who is not going to retire in another 20 years. It could be 20% for a very conservative investor. I would urge that have 15-20%, even if it is a very, very long-term portfolio. You are unlikely to depend on your investment for income. You have no dependence. Even your emergencies are taken care of out of the current cash flows. Still, to be able to optimize on special situations, opportunity that may arise.
Does that optimizing in special opportunities, does that count as timing the market?
No, it is not timing the market. When you are working on an asset allocation plan and a rebalancing plan to go with it, that is not timing the market. Because if it was timing, then you are waiting and looking at some opportunity. Yes, it amounts to a very methodical timing. And methodical timing which can go on and on if the market keeps going down. And the point is that it's a very dynamic system. The moment you have an asset allocation plan in your mind and a rebalancing plan, then I think it goes beyond timing. I think it is a structured timing with discipline.
So what would be the cleanest way to structure this?
The cleanest way to structure it is assuming you have no income requirement. assuming you have provided for all the emergencies substantially, which means that you have cash flows which can meet those needs, then you should think in terms of 100% equity allocation. But 100% equity allocation, I would still like to moderate it to 80%, 20% into fixed income, and have a very disciplined approach to rebalancing it. Tending to be 100% and keeping it at 80% will create some opportunity. You have to really see that temperamentally. Are you comfortable with that kind of decline and you not being able to profit from it? The moment you go beyond 65% equity, now it is a matter of what makes you comfortable. Whether it is 90%, 80% or 75% or 65%, that's up to you. But I would say that if everything else is covered very well, then keep 20%. Keep 1/5 of your money in fixed income to capitalize on special situations.
Right, so 20% in debt, but how to take out money methodically then?
No, for this person who is aspiring to have 100% into equity and he has no income requirement, he is taken care of by the rental income and the pension, and that itself is creating a surplus for him. So in that case, it's different. But I'm thinking of a retiree who has put his money in and is carrying a 50-50 equity debt portfolio or a hybrid portfolio of 75-25 and couple of aggressive hybrid fund or couple of balanced advantage fund. They should have up to 5% annual withdrawal rate, and just do your SWP and revise it every year. Don't commit to this SWP at a certain percentage of your assets or the worth of those investments. Keep it at 5%. Do a monthly withdrawal and revise it every year. And that way it will keep realigning. And I think you will end up being much better off over a period of time. Your capital might also grow substantially as a result of this.
So is there any framework that can help us avoid panic?
There are rules which will prevent panic. If your withdrawal rate is 5% and you are going to depend on that, I would say that you should have a minimum of 25-30% into fixed income. That is a buffer that you need, because our mind changes when the market turns bad. And we feel very differently when the market is roaring, zooming. Right now, we are in the middle of a situation. We are at a point when the market has generated no return or has given no return in the last 1 year. So I would say that if you are dependent on 5%, but that same thing can be very different if you are dependent on a 2% withdrawal rate. And you have a sufficient buffer as well. The situation could be very different. If you have absolutely no dependence on this investment, you can take a completely different view. It could be 15-20% and 30%. But generally speaking, I would say that at a 5% withdrawal rate dependence, you must have at least 25-30% into fixed income. These are frameworks, these are broad guidelines, and tweak them to your own requirement, tweak it to your own situation. And understand the rationale for these rules. There is a basis to these rules, but they are not, etched in stone.
Right. All right. Well, thank you, Dhirendra, for these insights. Now, moving on to the viewer's question. Alim Dhanani says between 2015 and 2017, he had invested in some regular funds through SIPs, which he later stopped but never redeemed. Currently, some of these funds have underperformed their benchmarks over the last 3 to 5 years, though their 10-year returns are still in line with the category or benchmark. So should he hold these funds for the long term or redeem them and reinvest into better performing funds?
He has two questions primarily. Moving from regular to direct plan, and he has stopped making new investment, but his money is, his investment is liable for the regular plans have marginally higher expenses. And moving from regular to direct plan should be done as early as possible if he is not using the intermediary anymore. If he can't bank on him for suggesting or making changes or transaction. And he is confident enough of taking those actions himself. You will break even in some time. And at least from here on, it will start costing you much less, half the cost sometimes. So that's the first point. And if you're seeking somebody's help, if somebody's hand-holding you, if somebody's providing you the confidence, if he's a bouncing board, by all means, stick around. Second is that look at the performance objectively. If your fund is not beating the benchmark, and if a fund is poorer than half of its peers in the same category, sell it and look for the better one. If it is so, because there is a possibility that your fund might be doing well, and you are simply disappointed by the market performance, but your fund per se is good enough. And that will be validated only by comparing it with the benchmark and comparing it with the peers. If you find that disappointing even on that, then you must sell it and move to the better ones.
Well, that's all we have for you in today's episode. Keep watching the space for more information and keep sending us your questions. We'll take up the ones that matter to most investors. Thank you for watching. Bye for now.